All right, good day everyone and welcome. Thank you for joining us today for this final webinar in our series discussing the impact of COVID-19 global pandemic. My name is Heather Sullivan with the Columbia Institute and I will be your moderator for today's webinar. We've already had some great conversations with several industry leaders over the past few weeks regarding appraisal legal liability, physical safety, professional responsibilities when dealing with COVID-19. And today's webinar is sure to deliver as we look to the future. Before we get started, I do have a couple quick housekeeping items. Today's webinar is being presented live. Our speakers are all coming to you virtually from individual work from home locations, so please bear with us if there is any Wi-Fi glitches or background noise or things of that sort. This webinar is being recorded and a copy of the recording will be made available on Columbia Institute's website. We also have a Q&A segment planned for the end of this webinar, so please submit your Q&A in the Q&A feature in the Zoom screen instead of in your chat window. That way we can make sure that all Q&A questions are anonymous. I do want to thank you if you submitted pre-submitted questions. It really helped us identify the information that you wanted covered, and then also the panelists that we have with us today. So greatly appreciated. With that, I'd like to introduce our panel of experts. Dr. Frank Notaf, Chief Economist with CoreLogic, is with us today. Frank leads the Office of Chief Economist and is responsible for forecasting trends in the global real estate, insurance, and mortgage markets. Our next speaker is Lisa Damares, the Vice President of Appraisal Issues at the Appraisal Foundation. Lisa has over 25 years of appraisal experience, and prior to joining the Appraisal Foundation in this capacity, served both on the Appraisal Standards Board and the Appraisal Practices Board. And then our final speaker will be Scott Reuter with Freddie Mac. Scott leads the effort for ongoing development and refinement of property valuation risk management strategies for Freddie Mac, and he does this by establishing and maintaining a credible quality assurance process across multiple lines of business support. So a big thank you to all of our guest speakers for collaborating with the Columbia Institute to make this information widely available. I know all of our lives are disrupted, our businesses and appraisal practices have been impacted, and what was once an easy appraisal assignment is now complex due to rapidly changing market conditions. So with all this going on, we are here today to better understand what a new normal may look like for appraisers in the months to come, and then determine where we can go from here. So I'd like to first introduce you to our panelist, Dr. Frank Notaf. And I had the privilege of attending a conference in early February where Frank spoke. And in this presentation, he provided an economic forecast that, among other things, addressed the impacts COVID-19 was having on or going to have on the US economy. And this was at a time when the United States hadn't even experienced an outbreak of COVID-19. And so in looking back, it's incredible how much foresight he had at a time when it wasn't even a thought in most of our minds. Now, with so much unfolding in the way of COVID-19, I'm very excited for you to all hear from him today, as many of these national trends and predictions will trickle down into the real estate markets you serve. So without further ado or delay, I'd like to hand it off to Dr. Frank Notaf. Welcome, and thank you again for joining us. I will turn the floor over to you.
Well, thank you so much, Heather, and it's good to see everyone today. As Heather mentioned, I'll kind of give an overview about the housing and mortgage market, what we're seeing out there. And indeed, things have just changed so much over the last 3 weeks, 3 months. Well, the last 3 weeks also, but the last 3 months especially. The pandemic has affected our personal lives and our work lives in ways that we hadn't even thought of or imagined way back in February. It's affected the economy as well. In February, the unemployment rate in the US hit a 50-year low. And we had low mortgage rates, and home sales were rising in January and February. It looked like the spring home buying season was going to be the best that we had seen in 13 or 14 years, since prior to the Great Recession. So things were really set up really well for what appeared to be a solid, strong, vibrant spring home buying season. Well, of course, things changed quickly over the last 3 months. And by the time we got to April, the unemployment rate had shot up to 14.7%, an 80-year high. And the economy was now in a very deep and severe recession. Now, it's impacted, of course, our work lives as well in the valuation space, and it's affected home sales. And I'll talk about some of those impacts in the market. One benefit, if there is any benefit, of being in the deep recession and the unprecedented response by the Federal Reserve and the federal government has been to push interest rates down to record low levels. We've never seen rates this low. And in fact, the 30-year fixed rate mortgage rate this past week in the latest Freddie Mac survey averaged 3.2% at or near a record low. And I do expect that we'll see it move a little bit lower over the course of the next few months. And so toward the end of this year, we're expecting 30-year fixed rate mortgage rates to set a new record low and average about 3%. And 15-year fixed rate mortgage rates are about a half a percentage point below that. And that product is very popular with people who refinance. So we're seeing a boom in refinance activity. Refi applications are triple what they were just a year ago. And 2020 is well poised to have the highest refinance volume since 2013. In fact, the refinance volume is so strong, it'll offset the decline in home sales that we are now forecasting for 2020, leaving the total volume of mortgage originations up relative to 2019. Not by a lot, but we do expect them to be up compared to last year. I want to turn and then share with you on the next slides some information that we've gleaned from CoreLogic data assets that cover the MLS and cover loan applications. And we get this data in at a daily frequency. And what we've done is we've aggregated the data into weekly activity, and then we compare the week with the same identical week 1 year ago. And so we'll look at some trends that we've seen in the marketplace, and they're very consistent with what you all know has happened in the marketplace in terms of the big drop-off in home purchase activity in April. Again, things have just changed dramatically over the last 3 months. We were expecting April home sales back in February. We were expecting April home sales to be the best that we had seen in probably about 14 years here in the US. But things changed dramatically, especially as we got to about mid-March. And on March 13th, the president declared a pandemic national emergency. And we saw the widening of shelter-in-place directives from local governments. And that led to a significant drop in activity in the housing market, especially for new listings. So when we look at new listings, it was really after that mid-March that new listings really started to plummet. Normally, that's when we see a pickup in new listings coming onto the market as we're getting ready for the spring home buying season. But this time around, everything has been turned upside down and new listings declined. And in fact, many agents and home sellers decided to pull listings out of the MLS at this time. and that contributed to the further decline in inventory listed for sale on the marketplace. And on the next slide, we can see what happened with sales. Not surprisingly, pending sales, which are the ratified contracts signed between the potential home buyer and the home seller, pending home sales really fell off as we got to mid-March, and we're down about 40% relative to the same week a year ago by the time we got to early mid-April. I like looking at pending sales because that's a leading indicator of what we expect to see with sales, with closings, because there's usually about 30 to 45 days typically between when the contract is ratified and when the settlement on the home occurs. And the other curve I have here on the chart is closings. And closings are clearly down substantially as well. And you can see that lag of about 30 to 45 days between the pending contract and the closings. Some of the good news that I see out there right now is the fact that pending sales, while they're still down from a year ago, they're not down that much from what they were a year ago. In fact, pending sales, contract signings have been rising from the real low point in mid-April. And I think that's a really a good sign and a harbinger of perhaps a rebound in home purchases that will happen either late spring or in the summer. So what I think we may see is that the spring home buying season has just been postponed by 3 months. It won't be in the spring this year, but it may very well be in the summer. And we're going to continue tracking this on a weekly basis to see if that holds true. On the next slide, we also look at home purchase applications. And that gives us a little different view on the nature of the applicants who have submitted home purchase applications. And one thing we can look at is the age of the potential home buyer, the applicant, and we can see whether they're first-time buyers or repeat buyers. And it's been a very interesting dichotomy when we compare activity relative to the same week a year ago. What we see is that it's the first-time home buyers that have been particularly active in the purchase market, and that's what's contributed to the rise in the home ownership rate. The U.S. Census Bureau reported in the first quarter that the home ownership rate in the United States had risen again, was 65.3%, and it was the highest we had seen in close to a decade. And that reflects first-time home buyers' active participation in the market, certainly in the first quarter, and that appears to be continuing as we move into May this year. And when we look at it by cohort, what we see is that it's the millennials, and most of the millennial buyers are first-time home buyers in the marketplace. They're the ones who've been persistently active in terms of purchasing homes and making that transition into first-time home ownership. They recognize that mortgage rates are at a record low. And the decline in mortgage rates to the level today compared to 1 year ago means that the monthly principal and interest payment is actually lower than it was a year ago, even though in markets, home prices have risen over the last 12 months. Even with that, the decline in mortgage rates to a record low has reduced the monthly principal and interest payment and made it lower than it was a year ago. And that's been very attractive to first-time home buyers. Now, for the millennials who are looking to purchase, obviously, we're looking at millennials who retained their job. As you know, over the last 2 months, 38 million American workers have lost their job and filed for unemployment insurance claims. a staggering number over a 2-month period. If you've lost your job and filed for unemployment insurance claims, it's unlikely that you're looking to buy a home. So we're looking at a subset of the millennial cohort overall that have retained their jobs, have their financial house in order, recognize the record low level of mortgage rates, and are ready to act. In my mind, this also poses, sets the market up for a swift rebound, maybe in the summer, but a swift rebound once the inventory that has been removed from the market comes back onto the market. And millennials are very well set to take advantage of the new inventory that comes onto the market, onto the MLS, and the record low level of mortgage rates to purchase. And so I am expecting a pretty good rebound potentially in the housing market as we get to the summer. When we look across different metro areas, the COVID-19 recession has impacted different areas more heavily than other metros. Some of the largest impacts in terms of decline in home purchase applications, declines in home sales, are often concentrated in some of the hotspots that we've read about in the news, where shelter-in-place orders have already been in place for 2 months or longer, such as in the Northeast, such as in California, in the Chicago area, places where the local economy has remained pretty strong, and shelter-in-place directives have not been as severe as in other locations, not as severe as in New York City, Chicago, Los Angeles. Those markets have seen a little bit of a dip in home sale activity and home purchase applications in April, but not that much. And you can see at the top of this chart, Dallas and Houston, while home purchase applications for April, which is the purple bar, are down from 1 year ago. They're not down that much, certainly not as much as in some of the other hard-hit markets. Let's turn to the next slide. I also want to share with you what we're seeing in our CoreLogic data for tenants and tenants applying for rental homes. And again, we're comparing weekly data, 2020 compared with 2019. And what we've seen is just like the shelter-in-place directives have impacted the home sales market, it's also impacted the rental market. Potential tenants have not been able to go see other apartments, and tenant applications also dropped substantially late March, early April, very similar to what we had seen in the home purchase market. In my mind, a lot of that is related to the shelter-in-place directives, and as those get lifted, we'll see a pickup, a rebound in tenant applications for rental homes, as we've begun to see already, and a narrowing of that difference, that gap between 2020 activity and 2019 activity. Let's turn to the next slide. I just want to share some thoughts or concerns we have about delinquency and foreclosure over time, looking forward. And what I have here in the schematic is just a very simple double trigger model or description of what ultimately leads to first delinquency and then the foreclosure. And what triggers the delinquency typically is a shock to the homeowner's income, some significant impact that leads to income loss. And for example, unemployment, unexpected illness or sudden death of a major breadwinner in the household are some of the typical triggers, the major triggers that lead to income loss and ultimately delinquency on a loan. And of course, with 38 million American workers having lost their job in the last 2 months, income loss and unemployment is a a big event for many households in the United States and can trigger a delinquency. Whether that delinquency ultimately leads to foreclosure or not depends on whether or not the family has sufficient equity in their home. And if we observe in the intervening months that prices are soft and prices are declining, that could wipe out the home equity that a household has and ultimately lead to foreclosure proceedings and an REO sale. Let's go to the next slide. And I'll mention as a precursor, as you know, the CARES Act provides up to 360 days of loan forbearance for those borrowers who have a federally backed loan. Now, the CARES Act was very clear in defining a federally backed loan means a loan that's owned by Freddie Mac or Fannie Mae, or is insured or guaranteed under a federal government program, such as FHA, VA, or the USDA Rural Housing Service Program. That's what defines a federally backed loan. Federally backed loans account for approximately 75%, or 3 out of 4, home mortgages in the United States. So it's not 100%, but it is the vast majority of mortgages in the US. And those borrowers who have been impacted in terms of an income shock, loss of job by the pandemic, they do have the right to request from their servicer that they be provided forbearance for a period of time. That may ultimately delay or postpone delinquency. It may ultimately prevent delinquency and foreclosure in some cases. But depending on the severity and the duration of the recession, that 360-day window may simply postpone the day of reckoning for many households, barring any additional federal support or programs or loan modifications that might be instituted at a later date. Well, with all that as a backdrop, let me turn and just share with you our projection for U.S. home price growth. As you know, home price growth has been running at a pretty good pace for several years now after the Great Recession. We've had about 9 consecutive years of home price growth in our national index. We're now forecasting the CoreLogic Home Price Index growth to slow dramatically in the next 12 months. Not immediately, not in the next 2 or 3 months, but as we look out 9, 12, 15 months from now, we are expecting a dramatic slowdown in price growth from 4.5% as we recorded in March of 2020 down to 0.5%, our forecast in March of 2021. And with home price growth at a national level slowing that much, that means there's a lot of jurisdictions that will have price declines. And we're forecasting 21 states will have a home price decline over the next 12 months. And of course, some metro areas will see bigger declines as well. Let's go to the next slide. I'll just show you some very, very high level, simple analysis we've done at a state level to look at this question of job loss, price declines, how that could affect delinquencies and foreclosures ultimately. And on the map, we have our estimates of the percent of borrowers who already had negative equity at the start of 2020. So think of this as January 1st, 2020, start of the year. Percent of borrowers by each state that had negative equity. And the table on the right-hand side just highlights 3 states we just picked to focus on in terms of job loss and the CoreLogic Home Price Index forecast for the next year. And let's just keep it simple. Look at at Louisiana, the bottom, the 3rd row of that table. Louisiana started the year with 9.8% of borrowers already in a negative equity position. And as a result of the pandemic, between middle of March and end of April, a 5-week period, job losses totaled 21% of the state labor force in the state of Louisiana, 21%. And that's just through the end of April, not counting any further job losses in May. Our home price index forecast for the state of Louisiana over the next 12 months is a 2% decline in home prices. And that's a state average. So that certainly means certain communities will have a larger decline than that. So there's certainly a lot of risk and potential for a challenging environment in a number of communities across the U.S., especially once the forbearance provisions of the CARES Act expire. So this is looking out into the middle of 2021 and beyond. And on the next slide, we did some simulations where we tried to do a thought experiment as to how this could translate into delinquency rise, looking longer term. So we're looking out toward mid to late 2021. What we see is either a 4-fold or perhaps as bad as a 10-fold increase in the serious delinquency rate from what it was during the month of March. So that's a substantial jump. Now, fortunately, at the end of March, during March, delinquency and foreclosure rates were at a generational low, lowest that we'd seen in about 25, 30 years. But we are expecting a spike. And we turn to the very next slide, we can see another simulation exercise we did using the CoreLogic credit risk model. It gave a very different model, very different approach. It gave us a similar result, looking out 2 years, so well beyond the CARES Act forbearance period. Looking out 2 years from now, we still find a 4-fold to 10-fold increase in the default rate on mortgages. So a lot of potential for risk out there, especially if the economic scenario turns out to be very severe and protracted. Thanks for your time, and I'll turn it back to Heather now.
Thank you, Frank. So much great information. And I just, in listening, it makes me want to brush up on my pre-foreclosure and foreclosure skills, if those are going to probably come in handy in the future. So as we build on Frank's economic outlook, I'd like to hand it off to our next panelist, Lisa Damaris with the Appraisal Foundation. Lisa is going to discuss what's going on in Washington these days and what we can expect from the Appraisal Foundation in the months to come. Lisa, I know you just recently took on this role with the foundation, so I want to welcome you and thank you for your continued service to our profession. And with that, I will hand it over to you. The floor is yours.
Thank you, Heather. Thank you so much for inviting me to your webinar today. It's an absolute honor to be asked to present information from the Appraisal Foundation here on your format. So specifically today, I would like to touch lightly on 4 topics and how COVID-19 relates to them. The first issue is a study that is being conducted to look into why only about 10% of all residential loan originations are required to have an appraisal. And the second topic I'll be discussing is what the Appraisal Standards Board is up to, then what the Appraisal Qualifications Board is up to, and finally, I'm going to direct you to the Appraisal Foundation's Coronavirus and Appraisers webpage. So on our first slide here, this is my first topic, the Government Accountability Office study. This is the GAO. So the GAO has begun a study to look into why only about 10% of all residential loan originations are required to have an appraisal. And specifically, this study began in February of this year when Congresswoman Maxine Waters and Congressman William Lacy Clay requested that the GAO initiate a study related to the 1989 enactment of Title 11 of FIRREA And if everybody can remember, Title 11 of FIRREA is what gives the congressional authority that requires institutions such as federally insured banks or credit unions to actually use state certified and licensed appraisers to perform appraisals in federally related transactions. So in 1989, when this was first enacted, this meant that roughly 90% of all residential loan originations required an appraisal. In 1989, 90% of all loan originations required an appraisal. But over the past few decades, the federal agencies which were charged with implementing Title 11 have taken steps to further and further limit the number of transactions for which an appraisal is required. I mean, just as one example, originally back in 1989, the transaction amount below which an appraisal was not required was $50,000. And in 1989, the median home price was $100,000. Now, currently, that transaction amount below which an appraisal is not required is $400,000, and the median home price is $250,000. So overall, with this one example I just gave you, and with all of the exceptions and carve-outs, or basically the number of instances where an appraisal is not required currently, has resulted in at least 90% of all residential mortgage loan originations currently not being subject to Title 11 appraisal regulations. So the foundation is really hopeful that the study will result in a return to the policies that what we believe was Congress's original intent, which was to require appraisals in most transactions to protect home buyers, taxpayers, and the public trust. And the study was actually just beginning in February when the COVID-19 issue emerged, and Washington more or less shut down their day-to-day operations while they dedicated resources to the national emergency. So when things begin to return to normal, or I guess the new normal, we believe that the study should pick right back up where it left off. We're hoping that should be as early as this fall. So we will try and update the public as more information becomes available. Perhaps keep an eye on our website or look for announcements from us we make regarding this study. If we move to our next slide now, I'll try to do a quick update on what the Appraisal Standards Board is up to. Since January, they've been busy doing two things. One is conducting their normal task, which already is quite a lot of work. And second, they've been providing COVID-related guidance for appraisers. Just this year alone, the ASB has been, drafting changes for the next edition of USPAP and writing and releasing several Q&As. And most of those Q&As have actually addressed COVID-related topics. All of these Q&As are posted on our website. I mean, I'll direct you to our website in a few minutes, so I'm not going to read them to you here in their entirety because it will take a little bit of time. I'm just going to give you a real quick summary of the Q&As that related to COVID topics. And if any of these topics come to be of relevance or of interest to you, be sure and go to the website to read the full answer, because I'm not going to be able to have time to read the whole answer to you right now. One of the first Q&As that we put out asked the question, are appraisers required to perform interior inspections during national health emergencies? So USPAP does not actually require interior inspections unless it's necessary to produce credible assignment results. So the requirement for an interior inspection comes from your client and from your assignment. Neither the Appraisal Standards Board nor the foundation has the authority to suspend interior inspections. So you as the appraiser just need to communicate with your clients, and we recommend you follow public health recommendations to understand the how, the when, and the if when you're making interior inspections. A second Q&A that the ASB wrote came about because of various GSEs, the government-sponsored entities, were needing to make loans during the COVID time and needed to keep the lending structure functioning. So they were adapting to the COVID situations and to appraisers not being able to allow into homes in some instances. So this question comes out of what they were doing. This second question asked, can an appraiser modify a form such as the 1004, which has a fixed certification and a fixed minimum scope of work? In and of itself, the modification of a standard report form does not result in a misleading appraisal report. But that's only true if the modifications do not create a conflict that cannot be properly understood. Now, since the GSEs were the entities themselves that both created and that require the use of these forms, and they were the ones allowing these modifications, it was simple to see that the forms could be understood with the modifications because the users would know what those modifications meant. Our third COVID-related Q&A asked, can an appraiser say they made an interior inspection if after visiting the exterior of a home, the homeowner then provided them with video showing the interior of the home? The answer is no. The appraiser still did not do an interior inspection. It cannot certify as such. It would be misleading to indicate that an interior inspection had not been done. In addition to these Q&As, and as I mentioned earlier, the ASB has been working on drafting the second exposure draft for the 2022 and 2023 USPAP. On the slide here, I know that I have a couple of bullet points about some of the proposed changes, but they have finished working through the process of issuing the first exposure draft, reading all the comments and determining what should be issued for the second exposure draft. That's actually ready to probably be issued tomorrow or the next day. So I'm not going to go through these bullet points here today. Just be on the lookout for an announcement from the Appraisal Foundation that says that exposure draft is ready for you to view. On to the next slide. I have some information regarding the activities of the Appraisal Qualifications Board. Probably most importantly, the AQB this year has issued 2 letters in the past 3 months to the Appraisal Subcommittee. One of these letters is detailed on this slide. The other letter is detailed on the next slide, but I'll get to that next slide in just a minute. This first letter recommended that the Appraisal Subcommittee grant the following allowances: to allow continuing education courses that were originally designed to be taught in person to be taught virtually, and to allow for extending the time frame for which one can complete their continuing education courses. Now, I just stated that the ASB issued letters asking the Appraisal Subcommittee to grant allowances, and this is actually a really good time for me to clarify a common misunderstanding, and that is the role of the AQB as it relates to the ASC and the states. So the AQB writes the minimum rules, for education, experience, and exam requirements for how to become an appraiser. That's it. They just write them. The states then adopt these rules into their laws, and they can add to them and make them stricter. And then the ASC, the Appraisal Subcommittee, they enforce these rules. So the ASC has the enforcement, is the enforcement arm of this, not the AQB. So the ASC is the only entity that can grant these temporary allowances. We actually can't grant them. We can only recommend that these allowances be given. And then the states can make the decision to choose to follow or not follow these allowances. So it's always your state that you want to check with as to what is or is not being allowed, because they're the ones making that determination. And the AQB just does not have any authority to force the rules or to grant the allowances, but it does have the ability, like I said, to encourage the Appraisal Subcommittee to exercise discretion and to grant allowances during national emergencies. And the ASC was extremely responsive, and they did this in the instance when the AQB issued the letter. The ASB acted very rapidly and did indeed recommend that these allowances be granted. Oh, and one thing I wanted to point out on this slide is that the AQB's first letter was issued just 5 days after President Trump declared a national emergency. So they are very, very responsive and in tune with what's happening in the environment, because on a daily basis, me especially, I hear from appraisers, regulators, and states about issues that they're facing. And so I just want to stress to everybody how important it is that if anything is of concern to you, be it for the standards or for the qualifications board, that you send a note, a memo, a question, your thoughts to the foundation. And we always filter those to the AQB and to the ASB. You know, our lifeblood is really getting feedback from the public, such as yourselves. This next slide, this is that second letter that I mentioned that the AQB issued to the ASC. This one occurred on May 15th, and this probably isn't as relevant to a large majority of the population, maybe just to some people. But in this letter, the AQB acted to recommend that the appraisal subcommittee grant allowances to the states to extend the 24-month time frame for appraisers to take and pass the AQB approved qualifying exam for their credentials. So again, that happened very rapidly as well. On this next slide here, if you are not already familiar with the Appraisal Foundation's website, this is my opportunity to introduce it to you. The Appraisal Foundation website is at www.appraisalfoundation.org. And on the opening slides, Heather, thank you. You had put a little visual in there with a cute little moving icon to see what you could click on to get to our COVID-related information. So when you go to our homepage, you're going to see a duplicate of this image that you see on your screen right here on the right side where it says coronavirus and appraisers. On our homepage, you actually just click on the image. It takes you right to this specific web page. And then here is where we have been compiling all the information regarding issues that we have found that are impacting appraisers because of the coronavirus. And these questions that I've typed here are the actual questions that are answered on that web page. So just as an example, you will see links to COVID-related guidance that's been issued by Fannie Mae, VA, FHA. You'll find information on our meetings. Are they happening virtually? Are they happening in person? And information on changes to the continuing education cycles, things like that. And while you were there on our website, you may wish to actually explore the entire website. There's a great deal of useful content on the website. We do update it continually, and we're continually adding more and more to it all the time. And with that, I will turn the floor back to you, Heather.
Thank you so much, Lisa. I appreciate that. And I do look forward to your update on the accountability study, because that's just fascinating to me. So again, everyone, your resource, it's there. Just go to the foundation website. There's lots of links about attending meetings, responding to exposure drafts, and then also questions and answers that relate to your practice. So probably the first place I'd start in many instances. So with this, brings us to our final speaker, Scott Reuter, Chief Appraiser with Freddie Mac. We heard from Scott at the beginning of our webinar series when we were introducing the new temporary appraisal flexibilities that the GSEs had in place to keep appraisers safe, as well as the home occupants. So we thought it was only fitting if we brought Scott back to the end of the webinar series for our look forward and a report on long-term effects COVID-19 is how it's impacting our appraiser profession and the mortgage industry going forward. Scott, it's a pleasure to have you again today. Thank you so much for being so generous with your time. I know Freddie Mac is working on several key endeavors that are going to shape the way we complete and process appraisals in the future. So without further ado, I'll let you take it from here to share all the great things you're working on.
Thank you. Thank you very much, Heather. And a big thank you to your entire team at Columbia Institute and the Friends at CoreLogic, everyone behind the scenes. And hats off to Lisa and following her remarks relative to our friends at the Appraisal Foundation and all the aggressive and clear messaging they did in the early days of the COVID crisis. Very helpful, and they were really one of the partners on the front line. First, as I always do, just a quick GSE disclaimer. Comments here today are my own. Any references to Freddie Mac policies and procedures is intended to be accurate. However, anyone's encouraged, please, to reference our current published seller servicer guide with any questions or clarifications you may have. On the agenda displayed, I'm going to cover a few topics here today. One is the flexibilities just in general in terms of from the lens of adoption and monitoring. To some of the still some of the common issues and concerns we see. They're very small, but just as a friendly reminder, to the appraisers where we're seeing and what we're seeing, and again, hopefully by way of trying to clarify. 3, some brief discussion around some of the tools and technology we're seeing in the marketplace, as well as what the future may look like, and then sort of having that future of the industry discussion with the backdrop of appraiser capacity and appraiser capacity nationwide and the aging of the profession. With this slide still up, basically, that's okay, Heather, thanks. So I don't really want to belabor a lot of the COVID flexibilities. I think you've all done, the industry's done a great job. The 3 main key points is, as part of the temporary exceptions we allowed, as everyone knows by now, I would think, desktop and exterior only assignments permitted for purchase transactions and certain refinance mortgages on a Freddie to Freddie. 1, 2, for purchase transaction mortgages, sellers, we're encouraging our sellers to utilize and obtain the desktop option of an appraisal where interior and exterior inspections are not available or permitted. And lastly, the minimum scope of work for a desktop appraisal does not include an inspection of the subject property. So we're allowing the appraiser from a desktop or exterior only option the ability to rely on public record, MLS data, and information from other third-party data sources to help identify the property characteristics. The purpose of the COVID flexibilities, obviously with revised certifications, was to create a maximum number of cases where the data would be available. That's in the purchase space. However, if adequate information is not available, then the appraisal really cannot be completed. We continue to monitor the results of the COVID flexibility appraisals, and for the most part, appraisers are doing a great job in adapting to the flexibilities and the guidelines announced. And again, that said, we do see a couple of trends. I just wanted to, as a friendly reminder, reinforce some messaging around here on the next 2 slides. So the first friendly reminder is around assuming condition. Interior condition assumption is not permitted on the flexibilities that we have issued relative to utilizing a desktop on a 100470 or an exterior only on a 2055 with the appropriate modified certs. Just as with a comparable sale, for the subject property, an appraiser must have a data source for the interior condition. The appraiser should use the same type of data sources that they utilize for comps, MLS, public records, etc. On the next slide, you'll see the other common question we get asked is around extraordinary assumptions. So extraordinary assumptions, we get asked, what about the interior condition, and can't we just assume? These 2, pardon me, tie relatively close to each other in terms of assumptions, and where appraisers want to make that extraordinary assumption on the interior condition. As an appraiser, I can relate to that. However, in terms of assumptions, these really fall under ordinary assumptions because, again, we're pointing towards and requiring the appraiser to have some sort of data source for that interior condition. It can be an MLS listing they find. It can be some public record or county data that they're able to verify. And as illustrated on the previous and on this slide, the wording and the wording relative to what's expected relative to these assumptions is really embedded in the form. I was guilty of this as a practicing appraiser too. I didn't always read everything thoroughly, so I would encourage you on the 2055, on the forms, just review the certifications, review the scope of work, limiting conditions, particularly in the modified scope of work, where we really do offer a lot more flexibility to the appraiser. So on the next slide, it's really a backdrop to a discussion around a couple things relative to risk. One, we get asked a lot, why in the world do GSEs prohibit adding assumptions? So with the previous existing or extraordinary assumption, why is that such a big deal for the GSEs? It's a big deal for the GSEs because, at least speaking for Freddie Mac, we at Freddie Mac manage risk, period. That's what we're in business to do. So from a risk perspective, appraisal reports are used by the GSEs as a critical collateral risk management tool. So this tool in this instance, which is based on this universal template of the form, we really cannot use it effectively or scale it uniformly if there's changes in the template or somebody buries or places an assumption in an addendum and potentially changes the condition of the appraisals and can have a big impact on risk. And these are really not new rules relative to the prohibition to adding modified certs and assumptions. long-standing. I think adding assumptions in the prohibition of certs has been in place on particularly the exterior-only appraisal form since it was introduced in 2005. So again, just friendly reminders around the assumptions, the property condition, the need for a data source, and really why that's meaningful to us and why that's important to us at Freddie Mac. So on the next slide, we really just tee up kind of a discussion around the tools and tech that we're seeing. There's little doubt that the current pandemic has really been a catalyst for change, and we're learning real time about the capabilities and advantages that certain tools and technology can provide. So appraisal technology has many benefits, including right now, reducing the risk for appraisers and actually giving appraisers the option of not entering a home. We've also messaged around some of this new technology now, even in the COVID-19 flexibilities and guidelines. So trying to clarify, Lisa and the foundation, she touched on this, really what this technology is now and what it's not. What it is not is for a 1004 Form 70 that requires an appraiser, for instance, to certify that they performed a complete visual inspection of the interior and exterior areas of the subject property. Virtual inspections are not sufficient. They're insufficient to comply with that on our Form 70 for an interior. Where they are permitted and where appraisers are free to deploy this technology voluntarily as a means of augmenting the exterior only or drive-by work to gain more information about the subject property. Without getting too deep into the weeds, certification 10 on the modified certs for COVID was eliminated, and that's the cert that prohibits the appraiser to obtain information from an interested party or homeowner on a typical course of business in a 100470. We actually relaxed that, so understanding that that homeowner, that property owner, that occupant may be the best source to put with some information that you have obtained that is going to verify interior property condition, layout, room count, and that type of thing. So personally, I'm very bullish on the advancement in the tools and tech available. And with the use of a lot of the virtual apps, the appraiser can really focus on really where their highest and best use, if you will, lies. So these next four slides animate, and Heather can kind of quickly bring them to life here. And basically, it's a slide I really like. It shows about an 8-year look back on appraisal volume, starting with refinance, starting with purchase count rather, refinance volume on top, and then the last horizontal line as she clicks it really is the appraiser capacity or appraiser availability we see across the UCDP portal submission. So this is combined Freddie Fannie data, and it's submitted purchase and refinance appraisals, again going back to 2012. And we see about 40,000 regular names of appraisers. I know the ASC count is actually higher. Not only do they count appraisers that likely don't do GSE work, but also do or multiple licensed. So this just shows there's continued and will be continued stress from time to time on appraisers. The next slide really deals with the age of appraisers. And this is a slide that I've carried around for a while too and updated, but just the reality that the aging of the appraiser population is a reality. We have roughly, depending on your count, 71% of appraisers are over the age of 50. So again, that's not doom, gloom, good, bad. It's just a reality that I think helps set a backdrop for modernization. And it's at least a reminder to me of kind of where the industry is, certainly where it was before we went into COVID, and how that kind of frames a discussion around what elements of this what elements of modernization and innovation may carry forward, may come from the margin to the mainstream going forward. So I know we're tight on time and we want to get some questions, and I want to respect everyone's time. So I would just say in closing, in my view, I think the flexibilities that the GSEs, really the industry worked on, went a long way to help ensure appraisers stay safe. We broadened our guidelines, allowed a lot of desktop and exterior only options, really keeping the safety of the appraiser and homeowners and everyone in the mortgage fulfillment process first and foremost. And secondly, I think that we're getting a real-time test and learn here that's continuing to help form and possibly shape what modernization and innovation may look like going forward. So anyway, hope that worked within the time frame, and thank you for inviting me here today.
Scott, thank you so much. And yes, I think your window shortened a little bit, so I appreciate you jamming all that great information in, and we'll definitely, we are a little bit short on time, and I do want to be very sensitive. I know you guys are all very busy, so we'll probably take most of our Q&A questions offline, and we'll just work with the speakers to provide responses, and then we'll send it out in an email. I did want to, one question I wanted to ask Dr. Frank Notap, just because I think it is relevant as we're trying to understand the markets that we're serving and the changes in the market trends. Frank, would you mind providing our audience with some of the, where would they look for these trends, both nationally and at a local level? What kind of data sources would be the best to, keep up on our display window as we watch these? Because I know that it's constantly changing.
Oh, that's a great question, Heather. Some of this material we have up on CoreLogic.com. We've set up a special COVID-19 webpage, and we've been putting up new housing market updates and analysis on that webpage. So we've got some of the charts I showed today. Some of them earlier versions are posted there as well. I mentioned that we're getting data in daily. We don't do tabulations by day because the data is very noisy. So we in the slides I was showing, I did group it by week so that it gives a clearer picture as to the trends that we're seeing in the marketplace. And periodically, the updated charts are posted on our COVID-19 web pages.
Fantastic. Yes, and I know you have a blog out there too. So definitely, if you guys see that, I've read it a couple times over the last few weeks, and it's very insightful and definitely keeps you informed. And then as well as with your MLS data, I mean, definitely be paying attention to your local sources, news, media. There's a lot of things that will give you insight into the new buyer profile and where people's mindset are as far as their reaction to all this that's going on. So I just wanted to apologize we didn't get to a lot of Q&A, but I will, like I said, gather all the questions, present them to the speakers, and get you some answers in the days to come, because this really is all the time we have. I also want to personally thank our panelists for the wealth of information they've shared with us today. Frank, Lisa, and Scott, we greatly appreciated your time. Great information and definitely useful information in our day-to-day, so thank you. And then I'd also like to thank you all for being here today. Please be safe out there, stay well, and we know you're going through a lot right now, so if there's anything we can do, we're here to help. Take care, everyone, and enjoy the rest of your day. Frank, Lisa, and Scott, again, thank you for participating.
Thank you,
Thanks,
Heather.
Heather.
Yeah. Good day, everyone.